Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Last week was an action-packed week, not just in terms of the global markets, but for India as well. When it comes to the global markets, we had four major central bank meetings. The Fed was the hawkish of them all, and dollar had a 10-week gain streak. For India, the big news was the inclusion in the JP Morgan Government Bond Index emerging markets, promising to bring billions of dollars worth of flows starting next year. This week is a little lighter. Morning, JK, what kind of themes will you be following for this week?
Good morning, Swaraj. Yes, we entered a very significant week where four major central banks were taking rate decisions. And as you said, Fed was the most hawkish of them all. And then on Friday, we found another central bank who, on contrary to others holding higher for longer stance, they almost announced a lower for even longer, kind of stance. They decided to keep the rates, Bank of Japan, at its current level of 0.1% and not even changing any other parameters in view of the many uncertainties that they have perceived. And with the Fed decision over, obviously we had many Fed members out in the open expressing their views. And all the three members that spoke on Friday in different forums indicated likelihood of another rate hike being necessary to achieve the 2% inflation target. And yes, on data, we did not have too many, but the ones which were announced reiterated the market's view that the US economy continues to perform better because the PMIs in Europe dropped, although marginally. And in UK, it showed a decline in both manufacturing and services, and the composite index actually fell to 46.8 from 48.7 in August. So the market also saw the retail sales being announced that came much lower than expected. So the perception is that Bank of England decision, which initially could have surprised some about being in a pause rather than hiking 0.25%, might have been driven by the early information they would have got about these data, and definitely the majority perception is that UK economy has started to feel the big impact on due to the rise in interest rates. So UK pound is likely to remain under pressure. On the yields, of course, yields did try to break into new highs on Friday, but they were subdued later because of the risk off sentiment that was observed in the stock market, and very few people wanting to chase the yields at higher levels, but definitely it's not coming off in a big way. Trend is still up, and there are some analysts who are looking at 5% for 10-year eventually. And while these look disruptive moves right now, but actually they are also correction of the disorderly fall in these interest rates, during the last 10 years since the GFC and also since COVID. There was no term premium at all for the 10-year and 30-year compared to the shorter tenor. So that's getting corrected. So 5% should not be a shock, but of course, it's all becoming unacceptable to the market players because of the way they have positioned. As far as the stocks are concerned, the hawkish stance from the central bank and also yields rising, and possibility of a government shutdown because of non-passage of bills in the in the Congress has led to stocks giving up some more gains on Friday. In fact, S&P 500 has fallen 6% from their July highs. Now there is also this news about auto industry facing a strike, due to which the demand for many components are coming down, and there is a derating of some of the stocks from their lofty highs. Yes, the US government shutdown of non-essential departments from late in the month or by the end of the month is something that analysts will be looking to very closely, because it's not about shutting down and then getting cleared later, but it is about the system of frequent shutdown and restart. All these possibly, I won't be surprised as rating agencies take further note of this. So that's the big negative as far as the US is concerned. On the rupee, we had a stunted rally on the INR after the decision of including Indian bonds into the JP Morgan EM bond index. Obviously, medium term very positive because flows up to 50 billion are being talked about. But apart from knee-jerk reaction, nothing more was expected immediately because it is 9 months away, and even if we assume that market starts to position themselves for those flows, it may not be earlier than March of next year. Therefore, in the near term, we still contend with a higher trade deficit in India, higher oil prices, dollar index being higher, yuan being weak, all these factors. The only other side is the RBI constant selling at 83.20 levels, which has capped dollars rise against the INR, despite the fact that RBI's bulletin itself mentioned the RER being at 105. So one can say that possibly inflation may be one of the reasons why they are trying to control the fall in the rupee. But market doesn't believe that rupee should be stronger, at least for the immediate term. Not seen much of a selling from exporters, but outflows continues both from oil companies and also from the FII side. Therefore, in the best case for USD INR is it holds below 83.30, helped by RBI. On the downside, definitely 80 to 80 holds. We look for some volatility because we are into the half year end, so you can probably see some more inch up in the forward premium because the short-term money rates are higher, and there can be a bit of flows at a higher level in the USD INR also because of the year end. Otherwise, for the week, of course, we have many other important numbers lined up, like PCE core inflation from US, GDP data from US, IFO numbers from Germany, and all important inflation, flash inflation number from Europe. All these are lined up. So I think don't really have a very quiet week, but not as much as last week. Thank you.
Thank you, JK. And I really liked what you said when it comes to the central bank themes, which are ongoing. Higher for longer themes is prevailing in the Western markets, but lower for longer theme is prevailing in Japan. So that was very interesting. And Fed members speaking post the FOMC reiterated the need for one more hike. But the US has its own set of troubles brewing with the auto sector strikes as well as the US government shutdown of non-essential departments. When it comes to rupee had a stunted rally post the JP Morgan GBI-EM index inclusion, but the real flows are expected only by March of next year. So till then, the factors of trade deficit, higher oil, higher dollar index, and weaker Chinese yuan will drive the pair, at least in the near term. That's it from us today. Thanks for listening, and tune in tomorrow for the latest in the financial markets. Thank you.